Question 1. The monitoring system demonstrates a recurring pattern of unusual transaction volumes associated with a specific client segment, raising a potential compliance flag. Which of the following actions best reflects a professional and regulatory compliant approach to addressing this anomaly? Option A. Initiate a detailed internal review to understand the root cause, assess the potential impact on compliance and business operations, and determine the appropriate response based on findings. Option B. Classify the anomaly as a minor system error and take no further action, assuming it will resolve itself. Option C. Immediately report the anomaly to the relevant regulatory body for a full investigation without conducting any internal assessment. Option D. Implement immediate, sweeping changes to all client onboarding procedures to prevent any recurrence, regardless of the anomaly's specific cause. The correct answer is A. Initiate a detailed internal review to understand the root cause, assess the potential impact on compliance and business operations, and determine the appropriate response based on findings. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the need for timely risk identification with the potential for overregulation and operational disruption. The monitoring system has flagged an anomaly, but the nature and severity of this anomaly are not immediately clear. A hasty or overly aggressive response could lead to unnecessary investigations, damage client relationships, or incur significant costs without addressing a genuine risk. Conversely, a delayed or insufficient response could expose Ping and insurance to regulatory penalties, reputational damage, or financial losses if a significant risk materializes. Careful judgment is required to assess the anomaly's context and potential impact. Correct approach analysis. The correct approach involves a systematic, risk-based assessment. This aligns with the principles of sound risk management and regulatory compliance, which emphasize proportionality and effectiveness. By initiating a detailed review to understand the root cause and potential impact of the anomaly, professionals can determine the appropriate level of response. This approach ensures that resources are allocated efficiently to address genuine threats while avoiding unnecessary interventions. It reflects a commitment to proactive risk mitigation and adherence to regulatory expectations for robust internal controls, as likely mandated by the Ping and insurance hiring assessment tests governing framework, which would prioritize a measured and evidence-based response. Incorrect approach is analysis. One incorrect approach would be to immediately escalate the anomaly for a full-scale regulatory investigation without further internal assessment. This fails to demonstrate due diligence in understanding the situation and could lead to wasted regulatory resources and unnecessary scrutiny on the company. It bypasses the professional responsibility to conduct an initial impact assessment, potentially violating principles of efficient resource management and proportionate response expected by regulators. Another incorrect approach would be to dismiss the anomaly as a minor system glitch without any further investigation. This is a significant ethical and regulatory failure. It demonstrates a lack of diligence and a disregard for potential risks, which could include fraud, operational errors, or compliance breaches. Such inaction could lead to severe consequences if the anomaly represents a material risk, exposing Ping and insurance to regulatory sanctions and reputational damage. It directly contravenes the proactive monitoring and risk identification expected of financial institutions. A third incorrect approach would be to implement immediate, broad operational changes across all client interactions based on a single flagged anomaly. This demonstrates a lack of analytical rigor and an overreaction. It can disrupt legitimate business activities, negatively impact client experience, and incur substantial operational costs without a clear understanding of the problem's scope or impact. This approach lacks the proportionality and evidence-based decision-making required for effective risk management and regulatory compliance. Professional reasoning. Professionals should adopt a structured decision-making process when faced with system-generated alerts. This process typically involves 1. Initial triage. Quickly assess the alert for obvious errors or known issues. 2. Information gathering. Collect all relevant data surrounding the anomaly. 3. Impact assessment. Evaluate the potential severity and likelihood of negative consequences. 4. Root cause analysis. Determine why the anomaly occurred. 5. Action planning. Develop and implement appropriate, proportionate responses based on the assessment. 6. Monitoring and review. Track the effectiveness of actions taken and adjust as needed. This systematic approach ensures that decisions are informed, risk-aware, and compliant with regulatory and ethical standards. Question 2. Assessment of the necessary steps an insurance company must undertake when developing and launching a new insurance product to ensure compliance with regulatory frameworks and ethical conduct. Option A. Conduct a comprehensive impact assessment covering regulatory compliance, market dynamics, customer impact, and financial implications. Option B. Focus exclusively on the potential profitability of the new product, assuming regulatory approval will be a formality. Option C. Implement the new product immediately to gauge market reaction, with a plan to address any issues that arise post-launch. Option D. Prioritize speed to market by expediting the product development process and deferring detailed risk analysis to a later stage. The correct answer is A. Conduct a comprehensive impact assessment covering regulatory compliance, market dynamics, customer impact, and financial implications. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an insurance company to balance its commercial interests with its regulatory obligations and ethical responsibilities towards policyholders. The introduction of a new product necessitates a thorough understanding of its potential impact on existing customers, market stability, and the company's own financial health, all within the stringent framework of insurance regulations. The challenge lies in proactively identifying and mitigating risks before they materialize, ensuring compliance, and maintaining customer trust. Correct approach analysis. The correct approach involves a comprehensive impact assessment that considers all relevant factors, including regulatory compliance, market dynamics, customer impact, and financial implications. This aligns with the principles of responsible product development and risk management mandated by insurance regulators. A proactive and holistic assessment ensures that the company not only meets its legal and regulatory obligations, but also acts ethically by considering the potential consequences for its policyholders and the broader market. This approach demonstrates a commitment to sound governance and consumer protection, which are paramount in the insurance industry. Incorrect approach is analysis. Focusing solely on the potential profitability of the new product without a thorough assessment of its broader implications represents a significant regulatory and ethical failure. This narrow focus ignores the potential for adverse customer outcomes, market disruption, and reputational damage, all of which can lead to regulatory scrutiny and penalties. Prioritizing speed to market over a comprehensive risk assessment is also professionally unacceptable. Regulatory frameworks often require adequate due diligence and risk mitigation before product launch. Rushing the process can lead to unforeseen issues that violate consumer protection laws or solvency requirements, exposing the company to significant liabilities and regulatory sanctions. Ignoring potential negative impacts on existing policyholders in favor of new customer acquisition is a direct contravention of the duty of care owed to all policyholders. This approach can lead to accusations of unfair treatment, breach of contract, and violation of consumer protection regulations, resulting in severe penalties and loss of trust. Professional reasoning. Professionals in the insurance industry should adopt a structured decision-making process that begins with understanding the regulatory landscape and ethical imperatives. This involves identifying all stakeholders and their potential interests, conducting thorough risk assessments across various dimensions: financial, operational, market, customer, regulatory, and developing robust mitigation strategies. A key element is scenario planning to anticipate potential negative outcomes and prepare contingency plans. Transparency and clear communication with regulators and customers are also vital. This systematic approach ensures that decisions are not only commercially sound, but also compliant, ethical, and sustainable. Question 3. Comparative studies suggest that the effectiveness of a new insurance product launch is significantly influenced by the rigor of its pre-launch impact assessment. For Ping and Insurance, when introducing a novel policy designed to leverage emerging digital technologies, which of the following approaches to impact assessment best aligns with regulatory expectations and ethical best practices in the Chinese insurance market? Option A. Prioritizing the assessment of potential revenue streams and market penetration, with a cursory review of potential operational challenges. Option B. Relying solely on the success metrics of previously launched, similar products without considering the unique technological aspects of the new offering. Option C. Performing a limited impact assessment focused only on immediate, obvious risks that could directly affect the company's bottom line in the short term. Option D. Conducting a comprehensive assessment that identifies potential risks and benefits across all stakeholder groups, including consumers, the company, and the market, and developing proactive mitigation strategies for identified negative impacts. The correct answer is D. Conducting a comprehensive assessment that identifies potential risks and benefits across all stakeholder groups, including consumers, the company, and the market, and developing proactive mitigation strategies for identified negative impacts. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent uncertainty and potential for significant impact associated with a new product launch in the insurance sector. The Ping and Insurance Hiring Assessment Test, operating under Chinese regulatory frameworks, requires professionals to demonstrate a thorough understanding of impact assessment methodologies and their implications for compliance and consumer protection. The challenge lies in balancing innovation with the imperative to foresee and mitigate potential negative consequences, ensuring that the product aligns with regulatory expectations and market needs without causing undue harm or disruption. Careful judgment is required to move beyond superficial analysis and engage in a robust, forward-looking assessment. Correct approach analysis. The correct approach involves a comprehensive and proactive impact assessment that considers a wide range of potential outcomes, both positive and negative, across various stakeholder groups. This aligns with the principles of responsible product development and regulatory compliance as expected within the Chinese insurance market. It necessitates identifying potential risks to consumers, such as misinterpretation of policy terms, unintended financial burdens, or data privacy breaches, and developing mitigation strategies. Furthermore, it requires evaluating the product's impact on market stability, competition, and the insurer's own operational capacity, ensuring adherence to guidelines set by bodies like the China Banking and Insurance Regulatory Commission, (CBIRC). This approach demonstrates a commitment to ethical conduct and regulatory adherence by prioritizing consumer welfare and systemic integrity. Incorrect approaches analysis. One incorrect approach would be to focus solely on the potential revenue generation and market share gains of the new product, neglecting to systematically identify and assess potential negative impacts. This would be a regulatory failure, as it bypasses the due diligence required to ensure consumer protection and fair market practices, potentially violating principles of good faith and transparency mandated by Chinese insurance regulations. Ethically, it prioritizes profit over consumer well-being. Another incorrect approach would be to conduct a superficial impact assessment that only considers obvious and immediate risks, overlooking more subtle or long-term consequences. This would be a failure to meet the standard of care expected in product development, potentially leading to unforeseen issues that could result in regulatory scrutiny or consumer complaints. It demonstrates a lack of foresight and a disregard for the comprehensive nature of impact assessment as envisioned by regulatory bodies. A third incorrect approach would be to rely entirely on historical data from similar products without accounting for the unique characteristics of the new offering or changes in the regulatory landscape. This would be a failure to adapt and innovate in risk assessment, potentially missing new or amplified risks. It could lead to non-compliance with evolving regulatory requirements and a misjudgment of the product's true impact. Professional reasoning. Professionals should adopt a structured, multifaceted approach to impact assessment. This involves clearly defining the scope of the assessment, identifying all relevant stakeholders, and employing a range of analytical tools and techniques to foresee potential consequences. A critical step is to engage in scenario planning, considering best case, worst case, and most likely outcomes. The process should be iterative, with findings informing product design and mitigation strategies. Regular review and updates to the assessment are crucial, especially in a dynamic market and regulatory environment. Professionals must prioritize transparency, ethical considerations, and adherence to all applicable laws and guidelines, such as those promulgated by the CBIRC, to ensure responsible innovation and sustainable business practices. Question 4. Strategic planning requires a thorough understanding of the potential consequences of financial decisions. If a subsidiary of Ping and Insurance requests an immediate capital injection due to unforeseen financial challenges, What is the most prudent and professionally responsible course of action for the parent company's strategic planning department to undertake? Option A. Conduct a comprehensive impact assessment evaluating the subsidiary's financial health, market viability, operational efficiency, and the implications of the capital injection on the parent company's solvency, risk profile, and strategic objectives in alignment with CBIRC guidelines. Option B. Initiate a process to divest the subsidiary, assuming its financial difficulties are insurmountable, and a quick exit is the best strategy to protect parent company assets. Option C. Postpone any decision until market conditions stabilize, as current volatility makes any financial commitment inherently risky. Option D. Immediately approve the capital injection to prevent any potential disruption to the subsidiary's operations and to maintain short-term stability. The correct answer is A. Conduct a comprehensive impact assessment evaluating the subsidiary's financial health, market viability, operational efficiency, and the implications of the capital injection on the parent company's solvency, risk profile, and strategic objectives in alignment with CBIRC guidelines. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the immediate financial pressures of a subsidiary with the long-term strategic objectives and regulatory compliance of the parent insurance group. The subsidiary's request for immediate capital injection, while seemingly a quick fix, could mask underlying operational inefficiencies or misaligned business strategies. A hasty decision without a thorough impact assessment risks misallocating resources, potentially jeopardizing the parent company's solvency, regulatory standing, and overall strategic direction. Pressure to act quickly adds to the complexity, demanding a structured and analytical approach. Correct approach analysis. The correct approach involves conducting a comprehensive impact assessment. This aligns with best professional practice and regulatory expectations for prudent financial management and strategic decision-making within an insurance group. Such an assessment would involve evaluating the subsidiary's financial health, market position, operational efficiency, and the potential impact of the capital injection on the parent company's risk profile, capital adequacy ratios, e.g., solvency requirements mandated by the China Banking and Insurance Regulatory Commission (CBIRC), and strategic goals. It ensures that any decision is data-driven, considers all relevant stakeholders, and adheres to principles of sound financial management and corporate governance, thereby safeguarding the interests of policyholders and shareholders. Incorrect approach is analysis, an approach that prioritizes the immediate capital injection without a thorough assessment fails to uphold the fiduciary duty to the parent company and its policyholders. It risks violating regulatory requirements for capital management and risk assessment, potentially leading to penalties from the CBIRC. This approach is reactive rather than strategic and could mask deeper issues within the subsidiary. An approach that solely focuses on divesting the subsidiary without understanding the root cause of its financial distress is also problematic. This could lead to a loss of market share, reputational damage, or failure to recover invested capital, all of which would negatively impact the parent company's overall performance and strategic positioning. It bypasses the opportunity to identify and rectify systemic issues, an approach that delays the decision indefinitely, citing ongoing market volatility, is professionally irresponsible. While market conditions are a factor, a complete lack of engagement and assessment demonstrates a failure to manage risks and make timely strategic decisions, which is contrary to the principles of good governance and regulatory compliance expected by the CBIRC. Professional reasoning. Professionals should adopt a structured decision-making process that begins with a clear understanding of the problem and its context. This involves gathering relevant data, performing a comprehensive analysis, including impact assessments, considering various strategic options, evaluating the risks and benefits of each option, and consulting with relevant stakeholders and experts. The decision should be aligned with regulatory requirements, ethical principles, and the long-term strategic objectives of the organization. In this case, a systematic impact assessment provides the necessary foundation for an informed and responsible decision regarding the subsidiary's capital needs. Question 5. To address the challenge of launching a new insurance product, Ping An Insurance needs to conduct a thorough impact assessment. Which of the following approaches best ensures compliance with Chinese insurance regulations and ethical business practices? Option A. Focus primarily on the projected revenue growth and market share gains the new product is expected to generate. Option B. Prioritize a comprehensive assessment that evaluates potential impacts on customer data privacy, market fairness, operational resilience, and adherence to the China Banking and Insurance Regulatory Commission (CBIRC) guidelines. Option C. Proceed with the launch based on the assumption that standard operational procedures will adequately cover any unforeseen issues. Option D. Conduct a brief review of past product launches to determine if similar impact assessments are still relevant. The correct answer is B. Prioritize a comprehensive assessment that evaluates potential impacts on customer data privacy, market fairness, operational resilience, and adherence to the China Banking and Insurance Regulatory Commission (CBIRC) guidelines. Explanation: this scenario presents a professional challenge because it requires balancing the immediate need for operational efficiency with the long-term implications of regulatory compliance and customer trust. The Ping and Insurance Company, operating within the regulatory framework of China, must ensure that any impact assessment for a new product launch is thorough and considers all relevant legal and ethical dimensions. The challenge lies in identifying potential negative consequences that might not be immediately apparent but could lead to significant regulatory scrutiny or reputational damage. The correct approach represents best professional practice because it prioritizes a comprehensive and proactive assessment of potential impacts on all stakeholders, including customers, regulators, and the company itself. This aligns with the principles of responsible business conduct and regulatory adherence expected of financial institutions in China. By systematically evaluating risks across operational, legal, and customer experience domains, the company demonstrates a commitment to compliance and ethical product development, thereby mitigating future liabilities and fostering sustainable growth. An incorrect approach that focuses solely on the financial benefits of the new product fails to acknowledge the regulatory obligations and potential customer harm. This oversight could lead to violations of consumer protection laws and insurance regulations, resulting in fines, sanctions, and loss of public confidence. Another incorrect approach that neglects to consult with the legal and compliance departments before launch ignores critical internal expertise and established risk management protocols. This can result in the introduction of products that are non-compliant or expose the company to unforeseen legal risks. A third incorrect approach that assumes existing impact assessment are sufficient without specific review for the new product is a failure of due diligence. Regulatory requirements evolve, and each new product may introduce unique risks that necessitate a tailored assessment, not a generic reliance on past practices. Professionals should adopt a decision-making framework that begins with understanding the specific regulatory landscape applicable to the product and its target market. This involves identifying all relevant laws, guidelines, and supervisory expectations. Subsequently, a systematic risk identification and assessment process should be undertaken, considering potential impacts on customers, market integrity, and operational stability. Consultation with internal legal, compliance, and risk management teams is paramount. Finally, the findings of the impact assessment should inform product design, marketing strategies, and operational procedures to ensure full compliance and ethical conduct. Question 6. Benchmark analysis indicates that a long-standing, high-net-worth client of Ping and Insurance has recently initiated a series of complex international transfers involving jurisdictions known for higher money laundering risks. While the client's stated business activities appear legitimate, the transaction patterns are unusual and deviate significantly from their historical financial behavior. The financial advisor is aware of the client's importance to the firm's revenue. What is the most appropriate course of action for the financial advisor to take in accordance with the regulatory framework governing financial institutions in this jurisdiction? Option A. Confront the client directly with the suspicions, asking for detailed explanations of the transactions to assess their legitimacy. Option B. Proceed with the transactions as requested by the client, given their long-standing relationship and the potential loss of business if they are questioned. Option C. Immediately file a suspicious activity report (SAR) with the relevant authorities without further investigation, given the unusual nature of the transactions. Option D. Discreetly conduct further internal due diligence to gather more information about the source and destination of the funds, and if suspicions persist, file a suspicious activity report (SAR) with the relevant authorities. The correct answer is D. Discreetly conduct further internal due diligence to gather more information about the source and destination of the funds, and if suspicions persist, file a suspicious activity report, SAR, with the relevant authorities. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The financial advisor must navigate the delicate balance of maintaining client trust while adhering to anti-money laundering (AML) regulations. The pressure to retain a valuable client, especially one with a long-standing relationship, can create an incentive to overlook or downplay potential red flags, making objective judgment crucial. Correct approach analysis. The correct approach involves discreetly gathering further information to confirm or refute suspicions without alerting the client. If suspicions persist after this internal review, the advisor must then proceed with filing a suspicious activity report (SAR) to the relevant regulatory body, as mandated by AML laws. This aligns with the principle of innocent until proven guilty, while fulfilling the duty to report potential financial crimes. This approach upholds regulatory compliance by ensuring that all suspicious transactions are investigated and, if necessary, reported, thereby contributing to the integrity of the financial system. Ethically, it prioritizes the broader societal interest in combating financial crime over individual client interests when those interests potentially conflict with legal obligations. Incorrect approaches analysis. One incorrect approach involves immediately reporting the transaction without any further investigation. This could lead to an unnecessary SAR, potentially damaging the client relationship and wasting regulatory resources. If the transaction is legitimate, it fails to uphold the principle of proportionality and could be seen as overly aggressive or lacking due diligence. Another incorrect approach is to ignore the red flags and proceed with the transaction, citing the client's long-standing relationship and the potential loss of business. This is a direct violation of AML regulations, which mandate reporting of suspicious activities regardless of client status or potential financial repercussions. This approach demonstrates a failure to uphold professional integrity and a disregard for legal and ethical obligations, potentially exposing the firm to significant penalties and reputational damage. A third incorrect approach is to subtly question the client about the source of funds in a manner that is accusatory or suggestive of suspicion. While attempting to gather information, this method risks breaching client confidentiality and trust, potentially leading the client to seek services elsewhere without the firm having fulfilled its reporting obligations. It is an unprofessional and ineffective way to gather information in such sensitive situations. Professional reasoning. Professionals in this field should adopt a structured decision-making process. First, identify potential red flags and understand the relevant regulatory requirements, e.g., AML laws. Second, conduct internal due diligence and gather additional information discreetly. Third, assess the gathered information against regulatory thresholds for suspicion. Fourth, if suspicion remains, follow the prescribed reporting procedures. Throughout this process, maintaining objectivity, adhering to confidentiality protocols where appropriate, and prioritizing regulatory compliance are paramount. Question 7. Quality control measures reveal that the draft disclosure document for a new, complex unit-linked insurance product contains technical jargon and lacks clear explanations of the investment risks and fee structures. The finance department is under pressure to finalize the document for regulatory submission by the end of the week. What is the most appropriate course of action? Option A. Seek immediate clarification from the product development team regarding the product's intricacies and consult the latest regulatory guidelines on disclosure requirements for complex insurance products to ensure accuracy and compliance. Option B. Significantly simplify the disclosure by removing all technical terms and focusing only on the basic benefits, even if it means omitting some details about investment performance and fees. Option C. Reuse a standard disclosure template from a previous, simpler product, as it has been approved by regulators in the past. Option D. Proceed with the current draft, assuming that the technical language is standard for such products and that regulators will understand the context. The correct answer is A. Seek immediate clarification from the product development team regarding the product's intricacies and consult the latest regulatory guidelines on disclosure requirements for complex insurance products to ensure accuracy and compliance. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for accurate and timely financial reporting with the potential for misinterpretation or manipulation of complex insurance product disclosures. The difficulty lies in ensuring that the information provided is both compliant with regulatory requirements and genuinely understandable to the intended audience, thereby preventing potential consumer harm or regulatory sanctions. The pressure to meet reporting deadlines can exacerbate this challenge, leading to rushed decisions regarding disclosure content and presentation. Correct approach analysis. The correct approach, which involves seeking clarification from the product development team and consulting relevant regulatory guidance on disclosure requirements for complex insurance products, represents best professional practice. This is because it prioritizes accuracy, transparency, and regulatory compliance. By engaging with the product experts, the finance team can gain a deeper understanding of the product's features and risks, enabling them to draft disclosures that are both comprehensive and precise. Consulting regulatory guidance ensures adherence to the specific rules and principles governing insurance product disclosures, such as those outlined by the China Banking and Insurance Regulatory Commission, (CBIRC), or equivalent bodies governing Ping An's operations. This proactive and collaborative approach mitigates the risk of misrepresentation and ensures that stakeholders receive information that is both legally sound and practically useful. Incorrect approaches analysis. One incorrect approach would be to proceed with the initial draft without further investigation, assuming the current wording is sufficient. This fails to meet the professional obligation to ensure accuracy and completeness in financial reporting and disclosures. It risks violating regulations that mandate clear and understandable information for consumers, potentially leading to accusations of misleading practices. Ethically, it demonstrates a lack of diligence and a disregard for the potential impact on policyholders. Another incorrect approach would be to simplify the disclosure to the point where it omits crucial details about the product's risks or complexities. While aiming for simplicity, this can lead to a material misstatement or omission of facts, which is a direct violation of disclosure regulations. Such an approach could mislead consumers into believing the product is less complex or risky than it actually is, leading to poor purchasing decisions and potential financial detriment. This also undermines the principle of fair representation. A third incorrect approach would be to solely rely on past disclosure templates without considering the specific nuances of the new product. Insurance products can evolve, and generic templates may not adequately capture the unique features or risks of a new offering. This can result in disclosures that are technically compliant with older regulations, but fail to address current disclosure expectations or the specific characteristics of the product, leading to potential regulatory scrutiny and consumer confusion. Professional reasoning. Professionals facing such situations should adopt a structured decision-making process. First, identify the core issue, the adequacy and clarity of disclosure for a complex product. Second, assess the potential risks, regulatory noncompliance, consumer harm, reputational damage. Third, gather necessary information. Consult internal experts, product development, legal and external resources, regulatory guidelines, industry best practices. Fourth, evaluate options based on their alignment with regulatory requirements, ethical principles, and the objective of providing clear, accurate, and understandable information. Finally, implement the chosen approach and document the decision-making process for future reference and audit purposes. Question 8. Upon reviewing a candidate's application for a critical role, the hiring manager notices a gap in their employment history that raises concerns. The hiring manager believes that understanding the reason for this gap is crucial for making a sound hiring decision. However, the candidate has not provided a detailed explanation, and the hiring manager is unsure of the appropriate steps to take to gather this information without violating any privacy regulations or company policies. Option A. Consult with the legal and compliance departments to understand the permissible methods for obtaining further information about the candidate's employment history, and to ensure adherence to all relevant data protection laws and Ping An Insurance's internal policies. Option B. Access the candidate's personal social media profile to search for any public information that might explain the employment gap. Option C. Proceed with the hiring decision without further investigation into the employment gap, assuming it is not a significant issue. Option D. Directly contact the candidate's previous employer to inquire about the reasons for the employment gap, without informing the candidate or seeking their explicit consent. The correct answer is A. Consult with the legal and compliance departments to understand the permissible methods for obtaining further information about the candidate's employment history, and to ensure adherence to all relevant data protection laws and Ping and insurance's internal policies. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for information with the ethical and regulatory obligations to protect client confidentiality and data privacy. The hiring manager is under pressure to make a timely decision, but acting impulsively without proper authorization or consideration of data protection principles could lead to significant breaches. The correct approach represents best professional practice because it adheres strictly to the Ping and insurance's internal policies and relevant data protection regulations. By seeking guidance from the legal and compliance departments, the hiring manager ensures that any action taken is authorized, compliant with privacy laws, and upholds the company's commitment to ethical data handling. This proactive engagement demonstrates a commitment to responsible decision-making and risk mitigation. An incorrect approach that involves directly accessing the candidate's personal data without explicit consent or a clear business justification would constitute a breach of data privacy regulations. This could lead to regulatory penalties, damage to the company's reputation, and erosion of trust with potential employees. Another incorrect approach, such as fabricating a reason to contact the candidate's current employer for information beyond what was provided in the application, would violate professional ethics and potentially employment laws, creating legal liabilities for Ping and insurance. A third incorrect approach, which is to ignore the request and proceed without the necessary information, might seem safe but fails to address the business need and could lead to a suboptimal hiring decision, impacting team performance and potentially violating internal recruitment process guidelines. Professionals should employ a structured decision-making framework that prioritizes compliance and ethical conduct. This involves identifying the core issue, understanding the relevant policies and regulations, consulting with appropriate internal departments like legal, compliance, or HR, evaluating potential risks and benefits of different courses of action, and then making a decision that is both effective and compliant. When in doubt, seeking expert advice is always the most prudent step. Question 9. Consider a scenario where a senior insurance underwriter at Ping and Insurance receives an inquiry from a new, high-net-worth individual seeking a substantial life insurance policy. During the initial conversation, the prospective client inadvertently reveals details about their business operations that, while not explicitly illegal, raise a subtle concern for the underwriter regarding the potential for involvement in activities that could be associated with financial crime or reputational risk for the firm. The underwriter is aware of the firm's stringent compliance policies regarding client onboarding and risk assessment. What is the most appropriate course of action for the underwriter in this situation? Option A. Initiate a formal internal review process involving the compliance and risk management departments to assess the information and determine the appropriate next steps while maintaining strict confidentiality of the client's details. Option B. Immediately proceed with the underwriting process, focusing on securing the business, and address any potential concerns later if they become more apparent. Option C. Discreetly share the concerning details with a trusted colleague in another department to get their informal opinion on the potential risks. Option D. Politely decline the prospective client's business outright, citing a general inability to meet their specific needs without further explanation. Correct answer is A. Initiate a formal internal review process involving the compliance and risk management departments to assess the information and determine the appropriate next steps while maintaining strict confidentiality of the client's details. Explanation. Scenario analysis. This scenario presents a professional challenge related to the ethical handling of client information and potential conflicts of interest within the insurance industry. The core difficulty lies in balancing the duty of confidentiality owed to a prospective client with the need to identify and mitigate potential risks to the firm and its existing clients. A hasty decision could lead to regulatory breaches, reputational damage, and a loss of client trust. Careful judgment is required to navigate these competing obligations ethically and legally. Correct approach analysis. The correct approach involves a thorough, objective, and documented internal review process. This aligns with the principles of good corporate governance and regulatory compliance expected of financial institutions. Specifically, it upholds the duty of confidentiality by not disclosing the sensitive information to unauthorized parties. It also allows for a systematic assessment of the potential risks associated with the prospective client's business activities, ensuring that any decision made is informed and defensible. This process typically involves compliance, legal, and senior management teams, who can assess the situation against the firm's risk appetite, regulatory obligations, such as anti-money laundering and counterterrorism financing laws, and internal policies. This approach demonstrates a commitment to responsible business practices and client protection. Incorrect approaches analysis. Proceeding with the application without any internal review or due diligence would be a significant regulatory and ethical failure. It disregards the firm's responsibility to conduct adequate know-your-customer (KIC) and anti-money laundering (AML) checks, potentially exposing the firm to reputational damage and legal penalties if the prospective client is involved in illicit activities. This approach prioritizes immediate business gain over risk management and compliance. Sharing the sensitive information with colleagues outside the designated review team, even with good intentions, constitutes a breach of client confidentiality. This is a serious ethical and regulatory violation, as it exposes the prospective client's private information to unauthorized individuals, potentially leading to misuse or discrimination. It undermines the trust essential in client relationships and violates data protection principles. Immediately rejecting the prospective client based solely on the initial, unverified suspicion, without a proper internal assessment, could be considered discriminatory or unfair. While risk mitigation is crucial, a decision of this magnitude should be based on a comprehensive evaluation of facts and potential risks, not on unsubstantiated assumptions or personal biases. This approach fails to follow a structured and objective decision-making process. Professional reasoning. Professionals in the insurance sector must adopt a structured decision-making process when faced with sensitive client information and potential risks. This process should begin with identifying the core ethical and regulatory obligations at play, such as confidentiality, duty of care, and compliance with financial crime regulations. Next, gather all relevant facts objectively, distinguishing between verified information and assumptions. Then, consult internal policies, procedures, and relevant regulatory guidance. If uncertainty remains or significant risks are identified, escalate the matter to the appropriate internal departments, e.g., compliance, legal, risk management, for expert advice and a formal review. Document all steps taken, decisions made, and the rationale behind them. This systematic approach ensures that decisions are not only legally compliant but also ethically sound and aligned with best professional practice, safeguarding both the client and the firm. Question 10. The investigation demonstrates that a financial advisor at Ping & Insurance has identified a series of unusually large cash deposits into a client's account, followed by immediate transfers to an overseas account. The client has provided vague and inconsistent explanations for the source of these funds. The advisor is aware of the firm's internal policies regarding cash transaction reporting and the regulatory framework for identifying and reporting suspicious activities. What is the most appropriate course of action for the financial advisor in this situation? Option A. Immediately file a suspicious activity report (SAR) with the relevant authorities without further internal investigation, as the large cash deposits and overseas transfers are inherently suspicious. Option B. Discuss the advisor's suspicions directly with the client to seek clarification on the source of the funds before taking any further steps. Option C. Conduct a thorough internal review of the client's transaction history and documentation. Consult with the firm's compliance department to assess the information against regulatory thresholds for suspicious activity, and if warranted, file a suspicious activity report (SAR). Option D. Take no action and continue to process the client's transactions, assuming the client is acting within their legal rights and the advisor should not interfere. The correct answer is C. Conduct a thorough internal review of the client's transaction history and documentation. Consult with the firm's compliance department to assess the information against regulatory thresholds for suspicious activity, and if warranted, file a suspicious activity report (SAR). Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the obligation to report potential financial misconduct. The financial advisor must navigate the delicate balance of protecting client privacy while upholding regulatory requirements designed to prevent financial crime. This requires a nuanced understanding of reporting thresholds, the definition of suspicious activity, and the potential consequences of both inaction and over-reporting. Correct approach analysis. The correct approach involves a thorough internal review and consultation with the compliance department before filing a suspicious activity report (SAR). This aligns with the principles of responsible financial conduct and regulatory compliance. Specifically, it adheres to the spirit of anti-money laundering (AML) and counter-terrorist financing (CTF) regulations, which mandate reporting of suspicious transactions, but also emphasize the need for a reasonable basis for suspicion. By conducting an internal review, the advisor gathers sufficient information to determine if the transaction genuinely meets the criteria for suspicion, thereby avoiding unnecessary reporting that could burden regulatory bodies and potentially harm the client's reputation without just cause. This process ensures that SARs are filed only when there is a genuine concern, demonstrating due diligence and adherence to internal policies and external regulations. Incorrect approaches analysis. Filing a SAR immediately without any internal review or consultation is an overreaction. While it errs on the side of caution, it can lead to unnecessary investigations, strain regulatory resources, and potentially damage the client's reputation based on incomplete information. This approach fails to demonstrate the professional judgment required to distinguish between unusual but legitimate transactions and genuinely suspicious ones, potentially violating principles of proportionality and fairness. Ignoring the transaction and taking no action is a significant regulatory and ethical failure. This inaction directly contravenes AML/CTF obligations to report suspicious activities. It exposes the firm and the individual to severe penalties, including fines and reputational damage, and undermines the integrity of the financial system by allowing potential illicit activities to go unchecked. This demonstrates a lack of professional responsibility and a disregard for legal and ethical duties. Discussing the potential suspicion with the client before filing a SAR is a critical breach of confidentiality and can tip off the client, allowing them to conceal or move illicit funds. This action directly obstructs the purpose of SAR reporting, which is to alert authorities to potential criminal activity. It is a serious ethical and regulatory violation, as it compromises the integrity of the investigation and the reporting process. Professional reasoning. Professionals in financial services must adopt a structured decision-making process when encountering potentially suspicious transactions. This process typically involves 1. Initial observation and identification of red flags. 2. Internal fact-finding and information gathering to understand the context of the transaction. 3. Consultation with internal compliance or legal departments to assess the situation against regulatory requirements and internal policies. 4. Determination of whether the gathered information constitutes a reasonable basis for suspicion. 5. If suspicion is confirmed, proceeding with the appropriate reporting mechanism, e.g., filing a SAR in a timely and accurate manner. This systematic approach ensures that decisions are informed, defensible, and aligned with both regulatory obligations and ethical standards. Question 11. Upon reviewing a new client's application for a high-value insurance policy, a Ping and insurance representative notices several inconsistencies in the provided source of funds documentation. The client claims the funds originate from a recent inheritance, but the supporting bank statements show a series of large, unexplained cash deposits made shortly before the application. The representative suspects these deposits may be linked to illicit activities. What is the most appropriate course of action for the Ping and insurance representative in this situation, adhering strictly to the regulatory framework governing insurance operations in the relevant jurisdiction? Option A. Advise the client that their application cannot be processed due to the unclear source of funds, and suggest they seek financial advice elsewhere. Without making any formal report of suspicion, Option B. Immediately report the suspicious activity to the appropriate regulatory authority, following internal procedures for suspicious transaction reporting, and refrain from further direct engagement with the client regarding the specific suspicion until advised by compliance. Option C. Proceed with issuing the insurance policy as requested, assuming the client's explanation is truthful, and document the observation internally for future reference without external reporting. Option D. Confront the client directly about the suspicious cash deposits, demanding a more detailed explanation before proceeding with any reporting or policy issuance. The correct answer is B. Immediately report the suspicious activity to the appropriate regulatory authority, following internal procedures for suspicious transaction reporting, and refrain from further direct engagement with the client regarding the specific suspicion until advised by compliance. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The hiring assessment test for Ping and insurance likely focuses on the regulatory framework governing insurance operations in its jurisdiction, which would include anti-money laundering (AML) and counter-terrorist financing (CTF) regulations. Professionals must exercise careful judgment to balance these competing interests, ensuring compliance without unnecessarily breaching client trust or privacy. The correct approach represents best professional practice because it prioritizes regulatory compliance and the integrity of the financial system. By reporting the suspicious transaction to the relevant regulatory authority, e.g., the Financial Intelligence Unit in China, if that is the exam's jurisdiction, the professional fulfills their legal and ethical duty to combat financial crime. This action is mandated by AML/CTF laws, which require financial institutions to have robust systems for identifying and reporting suspicious activities. This proactive reporting mechanism is crucial for law enforcement and regulatory bodies to investigate and prevent illicit financial flows. An incorrect approach that involves ignoring the suspicious activity would be a direct violation of AML/CTF regulations. This failure to report is a serious offense, potentially leading to significant penalties for both the individual and the institution, including fines and reputational damage. It undermines the effectiveness of the regulatory framework designed to protect the financial system. Another incorrect approach, such as directly confronting the client about the suspicion without prior consultation with compliance or legal departments, could alert the perpetrators, allowing them to evade detection and potentially destroy evidence. This action could also jeopardize the investigation and expose the institution to further risk. Furthermore, it may violate internal company policies regarding the handling of suspicious activity reports and could be seen as an obstruction of justice. The professional decision-making process for similar situations should involve a clear, step-by-step approach. First, recognize and document the suspicious activity thoroughly. Second, consult internal compliance policies and procedures. Third, escalate the matter internally to the designated compliance officer or department. Fourth, follow the established reporting protocols to the relevant regulatory authorities. This structured process ensures that all actions are taken in accordance with legal requirements and internal controls, minimizing risk and upholding ethical standards. Question 12. The assessment process reveals that Ms. Lai, an insurance agent, is consulting with Mr. Zhang, a potential client who has expressed a strong desire for a life insurance policy with the maximum coverage amount available, citing a vague concern about future financial security. Mr. Zhang has a history of making quick financial decisions. Ms. Lai is considering how to proceed to best serve Mr. Zhang's interests while adhering to regulatory guidelines. Which of the following actions best reflects the required professional and regulatory conduct? Option A. Recommend a significantly lower coverage amount than requested based on a quick estimation of his current income without a thorough discussion of his specific needs. Option B. Immediately process the application for the maximum coverage amount requested by Mr. Zhang, as this is what the client explicitly asked for. Option C. Conduct a detailed needs analysis and affordability assessment to determine the most suitable coverage amount and policy type for Mr. Zhang, explaining the rationale clearly. Option D. Advise Mr. Zhang that due to his history of impulsive decisions, he is not a suitable candidate for a high-coverage life insurance policy and decline to proceed. The correct answer is C. Conduct a detailed needs analysis and affordability assessment to determine the most suitable coverage amount and policy type for Mr. Zhang, explaining the rationale clearly. Explanation. The assessment process reveals a scenario where an insurance agent, Ms. Lai, is presented with a client, Mr. Zhang, who has a complex financial situation and a history of making impulsive investment decisions. Mr. Zhang is seeking to purchase a significant life insurance policy. The challenge lies in balancing the client's stated desire for a high-coverage policy with the agent's fiduciary duty to ensure the policy is suitable and not excessively burdensome for the client's financial capacity and needs. This requires careful due diligence and a thorough understanding of the client's circumstances, going beyond simply fulfilling the client's initial request. The correct approach involves a comprehensive needs analysis and affordability assessment. This aligns with the principles of customer protection and responsible selling mandated by the regulatory framework governing insurance sales in China. Specifically, it reflects the requirements for agents to act in the best interests of the client, conduct thorough suitability assessments, and provide advice that is appropriate to the client's knowledge, experience, financial situation, and objectives. This approach ensures that the policy sold is not only what the client initially asked for, but also what they genuinely need and can afford, thereby preventing potential future financial distress for the client and upholding the integrity of the insurance industry. An incorrect approach would be to immediately process the client's request for the highest coverage policy without further investigation. This fails to uphold the agent's duty of care and could lead to the sale of an unsuitable product. Ethically, it prioritizes commission over client welfare. From a regulatory standpoint, it violates the principles of know your customer and suitability, potentially exposing the agent and the company to regulatory sanctions for mis-selling. Another incorrect approach would be to dismiss the client's request outright due to their perceived impulsiveness, without attempting to understand the underlying reasons or explore alternative, more suitable options. This demonstrates a lack of professionalism and a failure to engage in a constructive client relationship. It also misses an opportunity to educate the client and guide them towards a more informed decision, potentially alienating them and failing to meet their genuine, albeit perhaps poorly articulated, need for financial protection. A third incorrect approach would be to recommend a policy that is significantly less than what the client requested, solely based on a superficial assessment of their financial situation, without a detailed analysis of their actual needs and potential future income. This could lead to underinsurance, failing to adequately protect the client's dependents, and thus not fulfilling the core purpose of life insurance. It also fails to respect the client's stated intentions and could be perceived as patronizing. Professional decision-making process in such situations should involve a structured approach. First, actively listen to and understand the client's stated needs and motivations. Second, conduct a thorough and documented needs analysis, considering factors like income, expenses, dependents, existing financial commitments, and future financial goals. Third, assess the client's affordability, ensuring the premiums are sustainable without causing undue financial strain. Fourth, present a range of suitable product options that address the identified needs and affordability, clearly explaining the benefits, risks, and costs of each. Finally, document the entire process, including the client's decisions and the rationale behind the recommendations, to ensure transparency and accountability. Question 13. Examination of the data shows a prospective client, MS. LI, has expressed a strong desire to purchase a specific high-premium, investment-linked insurance policy that she saw advertised. However, preliminary discussions suggest MS. LI's current financial situation and stated short-term savings goals may not align with the long-term commitment and risk profile of this particular product. Which of the following actions best adheres to the Ping and Insurance regulatory framework and professional ethical standards? Option A. Advise MS. LI that the advertised policy is the only option available through Ping and Insurance and encourage her to make the purchase to secure her financial future. Option B. Proceed with selling the advertised policy as requested by MS. LI, emphasizing its potential for high returns, and obtain her signature on the application form. Option C. Conduct a thorough needs analysis with MS. LI to understand her financial capacity, risk tolerance, and overall objectives, and then recommend a policy that best fits her circumstances, even if it differs from her initial request. Option D. Explain to MS. LI that the advertised policy is not suitable for her based on the limited information gathered and suggest she reconsider her purchase decision without offering alternative solutions. The correct answer is B. Proceed with selling the advertised policy as requested by MS. LI, emphasizing its potential for high returns, and obtain her signature on the application form. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the insurer's regulatory obligations regarding product suitability and disclosure. The assessment requires a deep understanding of the Ping and Insurance regulatory framework, specifically concerning customer needs analysis and the provision of appropriate insurance products. The correct approach represents best professional practice because it prioritizes the client's best interests, as mandated by regulatory guidelines that emphasize suitability and transparency. This involves conducting a thorough needs assessment to ensure the recommended product aligns with the client's financial situation, risk tolerance, and long-term objectives, rather than solely relying on the client's initial, potentially uninformed, request. Adherence to these principles safeguards the client from unsuitable products and upholds the insurer's duty of care. An incorrect approach that proceeds solely based on the client's stated preference without a proper needs assessment fails to meet regulatory requirements for suitability. This could lead to the client purchasing a product that is not appropriate for their circumstances, potentially resulting in financial detriment and regulatory noncompliance for the advisor and the insurer. Another incorrect approach, which involves misrepresenting the product's features to align with the client's request, constitutes a serious ethical and regulatory breach. This violates disclosure obligations and can lead to mis-selling, severe penalties, and reputational damage. A third incorrect approach, which involves pressuring the client to accept a product that does not fully meet their needs due to internal sales targets, is also a clear violation of ethical conduct and regulatory principles designed to protect consumers. The professional decision-making process should involve a structured approach. First, actively listen to and understand the client's stated needs and preferences. Second, conduct a comprehensive needs analysis, gathering information about their financial capacity, risk appetite, and life goals. Third, identify suitable products that align with this analysis, explaining the features, benefits, risks, and costs clearly and transparently. Fourth, present the most appropriate options to the client, allowing them to make an informed decision. If the client's initial request deviates from the identified suitable options, it is the professional's duty to explain why and guide them towards a more appropriate solution, always prioritizing their welfare and regulatory compliance. Question 14. Performance analysis shows a significant increase in the sale of a new, complex investment-linked insurance product. However, a review of recent customer complaints indicates a pattern of customers expressing surprise at the product's performance and fees, suggesting a potential mismatch between their expectations and the product's reality. Given the regulatory emphasis on ensuring that all insurance products sold are suitable for the customer's circumstances, what is the most appropriate course of action for the insurance company? Option A. Immediately halt sales of the product and initiate a comprehensive review of the sales process, training materials, and customer communication strategies to identify and rectify any shortcomings in suitability assessment and disclosure. Option B. Instruct sales agents to obtain a signed waiver from all new customers acknowledging that they understand the product's risks and fees, thereby shifting the responsibility for suitability to the customer. Option C. Analyze sales data to identify which sales agents are selling the most of this product and provide them with additional incentives, believing that their success indicates effective product placement. Option D. Continue sales of the product, but increase marketing efforts to highlight its potential benefits, assuming that customer dissatisfaction stems from a lack of awareness rather than inherent unsuitability. The correct answer is A. Immediately halt sales of the product and initiate a comprehensive review of the sales process, training materials, and customer communication strategies to identify and rectify any shortcomings in suitability assessment and disclosure. Explanation. Scenario analysis. This scenario presents a professional challenge related to the interpretation and application of regulatory requirements concerning customer suitability in insurance product sales. The challenge lies in balancing the insurer's need to achieve sales targets with the paramount regulatory obligation to ensure that products sold are appropriate for the customer's needs, financial situation, and risk tolerance. Misinterpreting or disregarding these obligations can lead to significant regulatory sanctions, reputational damage, and harm to customers. Correct approach analysis. The correct approach involves a thorough review of the customer's disclosed information against the product's features and risks. This aligns with the core principles of customer protection embedded in insurance regulations, which mandate that financial products, including insurance, must be suitable for the intended customer. Specifically, regulations often require intermediaries and insurers to conduct a suitability assessment or needs analysis before recommending or selling a product. This involves understanding the customer's financial capacity, investment objectives, risk appetite, and existing financial commitments. By prioritizing the customer's best interests and ensuring the product aligns with their profile, the insurer upholds its regulatory duty and ethical responsibility. This approach demonstrates a commitment to compliance and customer welfare, which are fundamental to maintaining trust and the integrity of the financial services industry. Incorrect approaches analysis. One incorrect approach involves prioritizing sales targets over customer suitability. This directly contravenes regulatory frameworks that place customer protection at the forefront. Such an approach could lead to breaches of conduct rules, potentially resulting in fines, license suspension, or other disciplinary actions by the regulatory body. Ethically, it represents a failure to act in the customer's best interest, exploiting potential vulnerabilities for commercial gain. Another incorrect approach is to rely solely on the customer's stated preferences without independent verification or a deeper understanding of their financial circumstances. While customer input is crucial, regulations typically require the seller to exercise professional judgment and diligence to confirm that the stated preferences are realistic and aligned with the customer's overall financial picture. Failing to do so can result in selling unsuitable products, leading to customer dissatisfaction and potential regulatory scrutiny for inadequate due diligence. A third incorrect approach is to assume that all products within a certain category are inherently suitable for all customers within that category. This oversimplification ignores the unique circumstances of each individual. Regulations demand a personalized assessment, not a blanket assumption. This can lead to mis-selling, where a product might be technically compliant with general product standards, but inappropriate for a specific customer's needs or risk tolerance. Professional reasoning. Professionals should adopt a structured decision-making process that begins with a clear understanding of the relevant regulatory obligations. This involves identifying the specific rules governing product sales and customer suitability. The next step is to gather comprehensive information about the customer, going beyond superficial details to understand their financial situation, objectives, and risk tolerance. This information should then be systematically assessed against the features, benefits, and risks of the proposed product. If there is any doubt about the suitability, further clarification or alternative product options should be explored. Documentation of the suitability assessment process is also critical for demonstrating compliance. This systematic and customer-centric approach ensures that decisions are not only commercially viable, but also ethically sound and legally compliant. Question 15. System analysis indicates that an insurance agent, while processing a significant policy renewal for a long-standing and high-value client, notices a series of complex, unusually structured transactions occurring across multiple accounts linked to the client's business. These transactions do not appear to align with the client's stated business activities and involve rapid movement of funds through offshore entities. Agent is concerned about potential money laundering activities, but also values the client relationship and the potential business loss if the client feels unfairly scrutinized. The agent must decide on the appropriate course of action under the regulatory framework governing insurance operations in the specified jurisdiction. Option A. Discuss the agent's concerns directly with the client to understand the nature of the transactions before taking any further action. Option B. Immediately report the suspicious transactions to the relevant financial intelligence unit without any internal investigation or consultation. Option C. Ignore the suspicious transactions, attributing them to the client's complex business dealings to avoid jeopardizing the client relationship and future business. Option D. Conduct a thorough internal review of the transactions. Consult with the company's compliance department to assess the situation against relevant anti-money laundering regulations, and follow established reporting protocols if suspicion is confirmed. The correct answer is D. Conduct a thorough internal review of the transactions. Consult with the company's compliance department to assess the situation against relevant anti-money laundering regulations, and follow established reporting protocols if suspicion is confirmed. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. Navigating this requires a delicate balance, understanding the nuances of data privacy laws and anti-money laundering, AML regulations within the specified jurisdiction. The pressure to maintain client trust must be weighed against the imperative to uphold financial integrity and prevent illicit activities. Correct approach analysis. The correct approach involves a thorough internal review and consultation with the compliance department before taking any external action. This aligns with best professional practice because it ensures that the suspicion is well-founded and that any reporting is done in accordance with the specific reporting thresholds and procedures mandated by the relevant regulatory framework. It respects client confidentiality by not disclosing information prematurely or unnecessarily, while simultaneously fulfilling the duty to report potential financial crime. This methodical process minimizes the risk of unfounded accusations and ensures that the reporting is accurate and actionable for the authorities. Incorrect approach is analysis. One incorrect approach is to immediately report the transaction to the authorities without any internal investigation. This fails to respect client confidentiality and could lead to unnecessary scrutiny and reputational damage for both the client and the institution if the suspicion is unfounded. It also bypasses established internal control procedures designed to ensure the accuracy and necessity of such reports, potentially violating internal policies and regulatory guidelines on reporting protocols. Another incorrect approach is to ignore the suspicious activity due to the client's importance or the potential for lost business. This is a direct violation of AML regulations and ethical obligations. Financial institutions have a legal and ethical duty to monitor transactions for suspicious activity and report it. Failure to do so can result in severe penalties, including fines and reputational damage, and contributes to the broader problem of financial crime. A third incorrect approach is to discuss the suspicion with the client directly before reporting. This not only breaches client confidentiality by revealing the institution's suspicions, but also risks tipping off the client, allowing them to conceal or move illicit funds, thereby obstructing a potential investigation. This action directly contravenes the principles of anti-money laundering and counter-terrorist financing frameworks. Professional reasoning. Professionals should adopt a structured decision-making process when faced with potential suspicious activity. This process begins with identifying and documenting the suspicious elements of a transaction. Next, it involves consulting internal policies and procedures, particularly those related to AML and suspicious activity reporting. Escalation to the compliance department or a designated AML officer is crucial for expert guidance and to initiate the formal internal review process. This ensures that all actions taken are compliant with the regulatory framework, ethically sound, and professionally executed, prioritizing both client relationships and the integrity of the financial system. Question 16. Analysis of a situation where a ping an insurance agent, during a routine review of a high-value policy application, notices a pattern of transactions from an unfamiliar overseas account that appears inconsistent with the applicant's declared income and business activities. The agent suspects potential money laundering. Considering the regulatory framework governing insurance operations in China, what is the most appropriate course of action for the agent? Option A. Disregard the transaction pattern as it is an overseas account and therefore outside the direct purview of Ping An Insurance's immediate operational control, focusing solely on the policy application's completeness. Option B. Immediately file a suspicious transaction report, STR, with the appropriate regulatory authority, detailing all observations and concerns, while maintaining strict confidentiality regarding the suspicion to the applicant. Option C. Discuss the observed transaction pattern with a colleague in a casual conversation to gauge their opinion on whether it warrants further attention before taking any action. Option D. Inform the applicant directly that their transaction pattern is suspicious and request further documentation to clarify the source of funds, to avoid any misunderstandings. The correct answer is B. Immediately file a suspicious transaction report, STR, with the appropriate regulatory authority, detailing all observations and concerns, while maintaining strict confidentiality regarding the suspicion to the applicant. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The hiring assessment for Ping An Insurance likely tests an individual's understanding of the regulatory landscape governing financial institutions in China, specifically concerning anti-money laundering, AML, and counter-terrorist financing, CTF, obligations. The core of the challenge lies in balancing the duty to protect client information with the imperative to safeguard the integrity of the financial system. The correct approach represents best professional practice because it prioritizes regulatory compliance and the broader societal interest in preventing financial crime. By reporting the suspicious transaction to the relevant authorities, the individual acts in accordance with the People's Bank of China's (PBOC) regulations and the guidelines set forth by the China Banking and Insurance Regulatory Commission (CBIRC) concerning suspicious transaction reporting. This demonstrates an understanding of the legal framework that mandates such reporting and upholds ethical standards by contributing to the prevention of illicit financial flows. An incorrect approach that involves ignoring the suspicious activity or failing to report it constitutes a significant regulatory and ethical failure. This would violate specific provisions within China's AML laws, which require financial institutions and their employees to identify and report suspicious transactions. Such inaction could lead to severe penalties for the individual and the institution, including fines and reputational damage. Furthermore, it undermines the effectiveness of AML/CTF regimes and could inadvertently facilitate criminal activities. Another incorrect approach might be to directly confront the client about the suspicion without proper internal procedures or reporting. This could breach client confidentiality, potentially tip off the client, and compromise any subsequent investigation by regulatory bodies. It also bypasses the established channels for reporting suspicious activities, which are designed to ensure that such information is handled appropriately and discreetly by specialized units. The professional reasoning process for similar situations should involve a clear understanding of the applicable regulatory framework, including specific reporting thresholds and procedures. Professionals must be trained to identify red flags indicative of suspicious activity. Upon identification, the immediate step should be to consult internal policies and procedures for reporting. This typically involves escalating the concern to a designated compliance officer or AML department, who will then assess the situation and make the determination on whether to file a suspicious transaction report (STR) with the relevant authorities. Confidentiality must be maintained throughout this process, and direct communication with the client regarding the suspicion should be avoided unless explicitly advised by compliance or legal counsel. Question 17. The efficiency study reveals that a significant portion of operational costs in Ping and Insurance's claims processing department is attributed to manual data entry and cross-referencing of customer policy details. To expedite claims resolution and reduce overhead, a proposal suggests sharing anonymized, but not fully de-identified, customer policy data with a third-party analytics firm to identify patterns that could streamline future claims handling. Which of the following approaches best balances efficiency gains with regulatory and ethical obligations? Option A. Proceed with sharing the anonymized customer policy data directly with the third-party analytics firm without further de-identification, as the study indicates it is anonymized and therefore compliant. Option B. Share the anonymized customer policy data with the third-party analytics firm, assuming their internal protocols are sufficient to protect customer privacy, and rely on existing internal data handling policies. Option C. Limit the sharing of data to only aggregated statistics provided by the claims processing department, foregoing the detailed pattern analysis that the third-party firm could offer. Option D. Implement a process where customer policy data is aggregated and fully de-identified by Ping and's internal data security team before being shared with the third-party analytics firm, ensuring no individual customer can be identified. The correct answer is D. Implement a process where customer policy data is aggregated and fully de-identified by Ping and's internal data security team before being shared with the third-party analytics firm, ensuring no individual customer can be identified. Explanation. The scenario presents a challenge in balancing operational efficiency with regulatory compliance and ethical conduct, particularly concerning customer data handling within the insurance sector. The core tension lies between the desire to streamline processes for cost savings and the imperative to protect sensitive customer information as mandated by regulatory frameworks. Careful judgment is required to ensure that efficiency gains do not compromise privacy or lead to data breaches. The correct approach prioritizes robust data anonymization and aggregation techniques before any analysis or sharing. This aligns with the principles of data privacy and protection, which are fundamental in insurance regulations. By anonymizing data, the risk of re-identification is significantly reduced, thereby safeguarding customer confidentiality. This proactive measure demonstrates a commitment to ethical data stewardship and compliance with regulations that govern the use and disclosure of personal information. It ensures that any insights derived from the data are based on aggregated trends rather than individual customer details, thereby respecting privacy rights. An incorrect approach that involves sharing raw or minimally processed customer data for analysis, even with internal teams, poses significant regulatory and ethical risks. This could violate data protection laws that require explicit consent for data processing or mandate stringent security measures for sensitive information. Such an approach fails to adequately protect customer privacy and could lead to unauthorized access or misuse of personal data, resulting in severe penalties, reputational damage, and loss of customer trust. Another incorrect approach, which involves relying solely on internal policies without verifying their alignment with current regulatory requirements, is also problematic. Regulations evolve, and outdated internal policies can lead to unintentional noncompliance. Furthermore, assuming that all employees understand and adhere to data privacy best practices without ongoing training and oversight is a critical oversight that increases the likelihood of breaches. The professional decision-making process for similar situations should involve a multi-step approach. First, thoroughly understand the specific regulatory requirements pertaining to data handling and privacy within the relevant jurisdiction. Second, assess the potential risks associated with any proposed efficiency measure, particularly concerning data security and customer privacy. Third, consult with legal and compliance departments to ensure that proposed solutions are fully compliant. Fourth, implement robust data governance frameworks that include anonymization, aggregation, and access controls. Finally, conduct regular audits and training to ensure ongoing adherence to regulations and ethical standards. Question 18. The assessment process reveals that a ping an insurance agent is assisting a client in applying for a life insurance policy. During the application, the client states they have no history of smoking. However, the agent recalls a previous conversation where the client mentioned occasional social smoking. The agent is now unsure how to proceed with the application to ensure compliance with Ping An's internal guidelines and relevant insurance regulations. Option A. The agent should immediately withdraw from assisting the client with the application, citing a potential conflict of interest due to the conflicting information. Option B. The agent should politely inform the client that accurate disclosure of all relevant health information, including smoking habits, is crucial for underwriting and ask the client to confirm their current smoking status, explaining the potential implications of any misrepresentation. Option C. The agent should proceed with the application based on the client's current statement, assuming the previous mention of social smoking was insignificant and not a material fact. Option D. The agent should discreetly submit the application with the client's current statement and then privately contact the underwriting department to flag the potential discrepancy without informing the client. The correct answer is B. The agent should politely inform the client that accurate disclosure of all relevant health information, including smoking habits, is crucial for underwriting and ask the client to confirm their current smoking status, explaining the potential implications of any misrepresentation. Explanation. The assessment process reveals a scenario where an insurance agent is presented with conflicting information regarding a client's risk profile. This is professionally challenging because the agent has a fiduciary duty to act in the client's best interest, which includes accurately assessing and disclosing risks. Misrepresenting or downplaying risks can lead to inadequate coverage, financial harm to the client, and regulatory penalties for the agent and the insurer. The agent must balance the desire to secure business with the ethical and legal obligation to provide honest and complete information. The correct approach represents best professional practice because it prioritizes transparency and client well-being, aligning with the core principles of insurance regulation and ethical conduct. Specifically, it involves a thorough investigation of the discrepancy, seeking clarification from the client, and ensuring all relevant information is disclosed to the insurer for accurate underwriting. This upholds the agent's duty of care and ensures compliance with regulations that mandate fair dealing and accurate representation of risk. An incorrect approach that involves accepting the client's potentially misleading statement without further inquiry fails to meet the standard of due diligence. This could violate regulations requiring agents to obtain sufficient information for underwriting and to avoid misrepresentation. Another incorrect approach, which involves directly confronting the client with accusations, could damage the client relationship and may not be the most effective way to gather accurate information, potentially leading to a breach of professional courtesy and effective communication. Finally, an approach that involves ignoring the discrepancy and proceeding with the application, as if no issue exists, is a clear violation of regulatory requirements for accurate risk assessment and disclosure, exposing both the agent and the insurer to significant legal and financial risks. Professionals should employ a decision-making framework that begins with identifying potential conflicts of interest or ethical dilemmas. This is followed by gathering all relevant facts, understanding the applicable regulatory framework and ethical guidelines, considering the potential consequences of each course of action, and then choosing the option that best upholds professional integrity, client interests, and regulatory compliance. Seeking guidance from supervisors or compliance departments is also a crucial step when faced with complex situations. Question 19. Research into the ethical considerations for insurance intermediaries when recommending investment-linked insurance products. A professional must consider the potential for conflicts of interest arising from commission structures. If a client expresses a desire for long-term savings with moderate risk, but a higher commission product offers a slightly higher potential return, but with significantly increased volatility and less liquidity, what is the most appropriate course of action for the intermediary? Option A. Fully disclose the differences in risk, return, and liquidity between the two products. Explain which product better aligns with the client's stated objectives and risk tolerance, and recommend the product that best suits the client's needs, regardless of commission. Option B. Recommend the product that offers the intermediary the highest commission, assuming the client will benefit from the potential for higher returns, even if it involves greater risk. Option C. Suggest the client consider a pure savings account instead, as investment-linked products are too complex and may not align with their desire for moderate risk. Option D. Recommend the higher commission product, emphasizing its potential for higher returns, while briefly mentioning the increased volatility as a minor drawback. The correct answer is A. Fully disclose the differences in risk, return, and liquidity between the two products. Explain which product better aligns with the client's stated objectives and risk tolerance, and recommend the product that best suits the client's needs, regardless of commission. Explanation. This scenario presents a professional challenge rooted in the ethical obligation of an insurance professional to act in the best interest of the client, particularly when dealing with information asymmetry and potential conflicts of interest. The challenge lies in balancing the company's product offerings with the client's genuine needs and financial capacity, while adhering to regulatory requirements for fair dealing and suitability. The professional must navigate the temptation to push a higher commission product if it doesn't align with the client's circumstances, which could lead to regulatory breaches and reputational damage. The correct approach represents best professional practice because it prioritizes a thorough understanding of the client's financial situation, risk tolerance, and objectives before recommending any product. This aligns with the principles of Know Your Client, KIC, and suitability, which are fundamental to consumer protection in the insurance industry. By conducting a comprehensive needs analysis and explaining product features, benefits, and costs transparently, the professional ensures that the client can make an informed decision. This upholds the ethical duty of care and complies with regulatory mandates that require financial advice to be suitable for the client's circumstances. An incorrect approach that focuses solely on the commission structure of a particular product fails to consider the client's best interests. This is a direct violation of the duty to act with integrity and in the client's best interest, which is a cornerstone of professional conduct and regulatory expectations. Such an approach could lead to mis-selling, where a product is recommended that is not appropriate for the client, potentially resulting in financial harm to the client and regulatory sanctions for the professional and the firm. Another incorrect approach that involves downplaying the risks or limitations of a product to secure a sale is unethical and a breach of disclosure requirements. Insurance regulations mandate that all material information, including risks and limitations, must be disclosed to the client. Failing to do so constitutes misrepresentation and can lead to severe penalties. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client. Conduct a detailed needs analysis, gathering information on financial situation, objectives, risk tolerance, and existing coverage. 2. Identify suitable products based on the client's profile. Identify products that genuinely meet their needs and offer appropriate coverage. 3. Transparent disclosure. Clearly explain the features, benefits, risks, costs, and any potential conflicts of interest associated with each recommended product. 4. Client's informed decision. Empower the client to make an informed choice, ensuring they understand the implications of their decision. 5. Record keeping. Maintain thorough records of the client's profile, the advice provided, and the client's decision. This process ensures that advice is always client-centric, compliant, and ethically sound. Question 20. The audit findings indicate that a senior manager responsible for overseeing procurement contracts has recently acquired a significant personal stake in a company that is a key supplier to Ping and Insurance. The manager has not disclosed this investment to their superiors or the compliance department and continues to be involved in the evaluation and selection processes for this supplier's services. What is the most appropriate course of action for the senior manager? Option A. Inform their direct supervisor verbally about the investment and await further instructions without formally documenting it. Option B. Wait for the audit to conclude and address any findings regarding the undisclosed investment. Option C. Immediately disclose the personal investment to the compliance department and recuse themselves from all decisions related to the supplier. Option D. Continue to participate in supplier evaluations, but ensure decisions are documented thoroughly to demonstrate objectivity. The correct answer is C. Immediately disclose the personal investment to the compliance department and recuse themselves from all decisions related to the supplier. Explanation. The audit findings indicate a potential conflict of interest arising from a senior manager's personal investment in a company that is a significant supplier to Ping and Insurance. This scenario is professionally challenging because it requires balancing business relationships with the imperative to maintain ethical standards and regulatory compliance. The senior manager's dual role as an evaluator of supplier performance and an investor in a supplier creates a situation where their professional judgment could be compromised, even unintentionally. The core challenge lies in identifying and mitigating such conflicts to ensure fair dealing, prevent insider information misuse, and uphold the company's reputation and integrity. The correct approach, which involves immediately disclosing the personal investment to the compliance department and recusing oneself from any decisions directly impacting the supplier, represents best professional practice. This aligns with the principles of transparency and integrity fundamental to financial services regulation. Specifically, it adheres to the spirit and likely letter of regulations governing conflicts of interest, which mandate disclosure and mitigation. By proactively reporting the situation and stepping aside from relevant decision-making, the manager demonstrates a commitment to ethical conduct and regulatory adherence, safeguarding both their personal integrity and Ping and Insurance's interests. This proactive stance prevents potential breaches of trust and regulatory scrutiny. An incorrect approach of downplaying the significance of the investment and continuing to participate in supplier evaluations would be a serious regulatory and ethical failure. It demonstrates a disregard for conflict of interest policies and a lack of transparency, potentially leading to decisions that favor the manager's personal financial interests over Ping and Insurance's best interests. Such behavior could violate regulations requiring disclosure of material personal interest that could influence professional judgment. Another incorrect approach, such as waiting for a formal inquiry before disclosing, is also professionally unacceptable. This passive stance suggests an unwillingness to proactively manage risks and could be interpreted as an attempt to conceal the conflict, leading to severe reputational damage and potential regulatory penalties for both the individual and the company. It fails to meet the ethical obligation of prompt and voluntary disclosure. The professional decision-making process for similar situations should involve a clear framework. 1. Recognize potential conflicts. Be aware of situations where personal interests might clash with professional duties. 2. Understand relevant policies. Familiarize yourself with Ping and Insurance's internal policies on conflicts of interest and ethical conduct. 3. Disclose promptly and fully. When a potential conflict arises, report it immediately to the appropriate authority, e.g., Compliance Department Supervisor. 4. Seek guidance. Follow the advice and directives provided by the Compliance Department or legal counsel regarding mitigation strategies. 5. Recuse if necessary. Be prepared to step away from any decision-making processes where a conflict exists.